I've got a couple positions on here this morning. I'm short the Russell 2000. That is, of course, a small cap index. So it is kind of like trading the S&P 500, but instead of the top 500 companies, the top biggest 500 companies in the US, the Russell 2000 is a mix of smaller companies. And again, I liked the prospect of shorting this one yesterday. And when this thing popped up yesterday, I took a very small position. This is not a big, you can see this is a big drop. I mean, this is probably about a 1% move. Actually, let's measure it. How far is that? Is that a 1% move? It's over 1% move, 1.13% move in the Russell. And so my profit on this one is just $450 right now, which is that's good money, don't get me wrong, but it's not very big on the account. It's because usually when I short, speaking completely honestly, shorting is way harder than going long in a bull market. But I like the downside for the Russell. And part of the reason for that is this popped up on my watch list yesterday. So the Russell, why the Russell? Why the Russell now? Well, again, I'm a broken record on this stuff, but we've been on this theme here recently. If you've been tuning into the show, you know that I've been talking about a lot the economic data that seems to be coming in cool. GDP numbers, PMI numbers, retail sales numbers, unemployment rate ticked higher, interest rates, have been on the rise recently. They've come down a little bit today. But any slowdown in the economy, I've talked about the Russell a lot. I talked about it a lot yesterday. The Russell, in order for the Russell to go up a lot, what I think you need is you need to see great growth in the economy, which we arguably are not seeing so much of right now. The economy in the US has been stronger than expected, don't get me wrong, but it's showing signs of cool down. Inflation seems to be getting in the way of the consumer. The consumer is starting to feel the pinch of, go figure, you go to the store and everything is double the price. That's going to start to materialize. And so, I'm kind of still bearish on I am still bearish on the Russell. So growth, you need good growth. And you need interest rates to be accommodative. So what do I mean by that? Interest rates, remember, this is borrowing costs. Borrowing costs are very important to companies that are smaller and trying to grow. Think about this just conceptually. If you're a small business, and these are not small businesses. If you're in the Russell 2000, you're not tiny, but you're definitely not the big ones, right? You're still growing, and growing companies, to grow fast. How do you grow fast if you're a company? If you want to grow really fast, you take on debt and you deploy that money to grow your company quickly. So that's how small companies can grow quicker, right? Think about a quick example, like McDonald's in the early days. When McDonald's was a small business, they borrowed tons of money so that they could build out tons of restaurants. They had a good model, but in order to grow, they needed a corner restaurant everywhere. How do you do that? You borrow money and you build it out, and then you pay off the debt and you have a huge profitable company. But right now, interest rates are still kind of high, and the growth story is, in my view, a little less attractive than it was. So for me, the Russell is not today, not right now. Now, if you get an environment where interest rates are coming down, but the economy is staying solid, the Russell's the place to be, no question. That's where I want to be long the Russell, and I want to be long the Russell aggressively. But right now, I don't see that scenario. And I'm not saying like, oh, I'm reading the tea leaves. No, software is helping me to spot that right now, economic prints are missing expectations as a collective, and that is showing me growth may be challenged. Let's stay short the Russell for now.
Did you know that we have 100% free trading tools and data available for you on our website, a1trading.com, right now? We have free courses for you to browse. You can also check out things like retail sentiment. And and free articles from our analyst Frank that include things like Edgefinder screenshots and trade setups. You can find all of this and so much more for free right now on our website, a1trading.com.
Gold, I'm still long, guys. I have a position on this one. Has not made a huge move either direction. For gold, I'll keep it pretty brief in terms of analysis. Same concept. Slowing economic data keeps me bullish on both the bond market for now, as well as gold. So I like gold, I like bonds, and right now, again, I'm holding that short on the Russell. So that's predominantly where I'm positioned. On top of that, on my S&P 500 trade from April, I'll get to that in a second, actually. So here's the thought process on gold for me. Tomorrow, inflation is very, very important to gold. If you get inflation numbers that are improving, like coming down, gold probably does okay. But here's my opinion on this. Even if the inflation numbers come in hot tomorrow, as long as we don't break these lows, I'll stay in gold. For me, I think that if inflation, if the economy is showing signs of slowing, but inflation is hot or cold, colder than anticipated, I still like the story for gold longs right now. So it almost doesn't matter tomorrow. It doesn't matter what happens with the inflation figure tomorrow, as long as it's not ridiculously one way or the other. I like gold longs right now, but listen carefully here. I'm not saying no matter what, I'm full margin, I think it's going up. I'm just saying if you get a hot inflation read, the market probably will sell this, which I'm fine to stay in as long as we don't break lows. That's the difference. I have a stop loss in place. If price breaks the lows here, take a look at the 4-hour chart. As long as price doesn't break through these lows on GLD, I stay in the trade. If it closes below the lows, I take a loss and I move on. There goes the Russell. Very, very nice price action here this morning. IWM hit that level perfectly, sold off. If you're a member in the group and you caught the Russell trade, shout out to you. That's awesome. We got a nice little move there. Little to no drawdown on the Russell. Look at that. $600 on a small trade. I will take that all day. You'll notice that usually when if I short the indices, it is usually on small size. It's because it is just a harder trade, unless I think Lee made a point earlier. Find it hard to short unless it's a full-on bear market. Rarely found in gold or indices. It's difficult, right? Shorting is not something that I do frequently, but the trade for me was very much lined up. Software indicated Russell looks bearish. Price came up to a level that was just so crystal clear. I mean, 4-hour chart. This is a beautiful trade so far. In fact, if this closes like this on the 4-hour, I'm going to trail stops into profit, and I'm just going to say, I'm just going to let it ride. Whatever happens, happens. But I really like this. I mean, this is the price action here to the downside, very clean, and I'm feeling really good that this level held so tight. Like, this came up to resistance yesterday. I told Frank I'm going to get short to the Russell. He watched me take the trade, and he said he was going to join me on it. I don't know if he took it or not, but we will see. Dollar index is up here this morning, probably contributing to a little bit of bearishness. Look at this, guys. Look. So let's follow up on the analysis from yesterday with the dollar index. We talked about how this candle closed. If it closed weak, to point out my own analysis, I said if it closed weak, be careful, it could go lower. So I was wrong about that, because look at this. We've got a weak candle close, but the dollar index is now pushing right through the highs. So if you get actually, I mean, a candle close like this today, very, very strong for the dollar in the short term. But I think you just have to be careful, because it's all about tomorrow's CPI. CPI is definitely the most important component of this week. At the end of the day, if you get a very hot inflation read, it is going to throw a loop in this market. And a hot inflation read could shoot the dollar back up to 106.4 in a heartbeat, right? It could be very quick. That's if we get hot inflation. But again, I want to make this distinction because a lot of times people will show up to a CPI live stream. We'll have, a ton of people watching the show tomorrow, and you'll see it. If you're a regular fan, you'll see them too. There will be messages tomorrow, people saying, Nick, what way is the dollar going to go? Is it going to go up or down? Or should we sell gold? Should we buy gold? And I will be the first one to say, I've been doing this a long time. I don't predict what the news is going to be, right? I react to it. And I know it sounds like cliche and everybody says that, but genuinely, the CPI report tomorrow is an unknown. It's a question mark. You and I don't have the luxury of knowing the economic data before it gets released. But when it does get released, if you know how to trade with fundamentals, you know that it can set up some really nice trends that are not just a 30-second blip. They can be trends that form for the next day or even weeks, right? If you get a really strong inflation read, like a hot inflation read, meaning higher than expected, and let's go take a look at what expected is today. So let's go over here. I'm just going to pull this up really quick. So tomorrow, you have inflation expectations for a 3.4% year over year report. That is the same as the previous. So let's just throw out some scenarios. Let's think through these together, and let's do some prep work. Let's do our homework. If you get CPI year over year tomorrow to come in at 3.5%, the market, what will it do? Think to yourself, what will happen to the dollar if inflation is sticky and actually rising back up? How would that cause, what would happen to the dollar? What would happen to stocks? What would happen to gold? If this happens, the dollar probably goes up pretty strong. You probably get a huge green candle. In fact, where's my perfect candle? Yep. You might get a perfect candle if you do, in fact, see a green candle to the upside for 3.5%, because that would be higher than expected. That would be, think about what that's saying. Okay, inflation is not coming down. Inflation is actually rising. Not good, right? And that would, again, produce your huge green candle to the upside for the dollar. But what if it comes in at 3.3? And again, I don't know what these numbers are going to be. This is why we are practicing. We are preparing. If you get 3.3, the dollar index does the opposite. At 3.4, you probably get some selling of the dollar, but not too much, not a huge move. If it comes in as expected, probably won't do a ton of movement. It could, but really it would be a surprise one way or the other that would cause a big move. So if the dollar gets really strong, obviously that's going to probably put some pressure on gold. It's going to put some pressure on stocks. So if you get a 3.5%, the market is not going to like that. As in the market being the S&P 500, stock investors, gold traders, they're going to sell aggressively, most likely, right? If you get 3.3, they'll do the opposite. They'll cheer it and they'll send things higher. So I just want to do a little bit of prep work for tomorrow's CPI report. It is very, very important. So we will be live streaming for that event. Let's take out stocks. We can just look at ETFs, options, bonds. Yeah, that's good. All right. So VOO, XLK. These are two positions that are, I have three positional trades open right now. TLT, the S&P 500, and the technology ETF XLK. So I have sold, I've sold calls against my positions. And it very much depends on what happens tomorrow, because if the market drops tomorrow, these will look genius. And if the market rips higher tomorrow, these will look foolish. But here's where I'm at with this. So let me show you this. So if I go over to, let's go XLK for a second. So if you don't know what XLK is, it is just an ETF that tracks a basket of technology stocks, specifically like NVIDIA and Microsoft and I've got some exposure to many different companies. Well, what I did is I sold a call at $220 per share. Well, I sold 10 contracts. What that means is that my position, if this market rips higher past this level, I won't make any gains past this point. I'll make gains up to that point, but I've sold calls. So I will sell my shares to someone else. They have the right to buy my shares at 220 at any time. They could buy it right now. I'd be happy if the person who bought these calls exercised their calls right now. I would make a big profit on a move that never happened. So that would be fine by me, but they're not going to do that. So if this market rips higher though, then what happens is I don't lose money, but I'm hedged. I own 1,000 shares myself. And if this market rips past the highs, then I see no gains past this point. Because remember, I agreed when I sold the calls here to sell my position at $220 per share. So I'm floating a really great profit on this. But why would I sell calls? What's the benefit in selling calls? Well, I get paid a premium. And in fact, the premium that I collected for selling this call came out to just around $2,000. So on my position, I got paid $2,000. So I already got paid the $2,000. As soon as you sell a call, you get paid the amount. So I'm up $2,000. So why wouldn't everybody just be selling calls all the time then? There is some downside, and the downside is the lack of upside if this market rips higher. So if tomorrow's CPI, I have some quote unquote risk, the opportunity cost, right? If inflation comes out really cool tomorrow, the market will probably scream higher and I will miss out on some of the gains. But I'm okay with that. I accept that I will potentially cut off my upside, just like a take profit order, by the way. A take profit order is technically capping your upside. I'm capping my upside in exchange for $2,000. Why would I do that? Because I think there may be some pullback coming in this market. That's why, right? The reason I might do that is because I think that the market may not do that move. If it does happen, then again, I miss out on some of the gains. But so far, this market's kind of gone sideways, and NASDAQ hasn't really gone too far either direction. And I would say that in the short term, I am leaning bearish rather than bullish on some areas of the market, specifically like the Russell.
So Frank and I talked about this yesterday. You had brought this up as well before you jumped off the stream yesterday. But I wanted to zoom in here and let's go to the last like 7 years, because what I kind of pinpointed on the inverted yield curve with the 3-month 10-year is I would be quite concerned if we go into Q4 this year and this is no longer inverted and we have a rough and tumble Q4. So back in 2001, October to December was a down quarter, and that proceeded to give us a pretty hard hit recession for the next year. 2007, 2008, we came out of the inversion. We had a down quarter in 2007, 2008, early quarter, and everything was down, making lower highs, lower lows. What kind of makes me nervous about this environment is if we zoom out and show that 34-year history, this is uncharted territory, right? That's what nobody really knows how this plays out, because yes, we had a recession. Yes, we had a recession. Yes, we had a recession. We had the downturns in the market that were very violent. This obviously was short-lived because we have the tools and resources to buy our way out and debt fuel these rallies. But this was ugly, and this was ugly. But this is, what do we do with this? What makes me nervous is if this thing comes out of the inverted territory, what I zoomed in on, and I'm going to share this with you, the average inversion to recession is 24 months. Okay. So when I zoomed down on the edge finder, this is what I thought was interesting. It's October of 2024. That would be 24 months. See this? So right here, like end of October 2022, that's when we started the inversion. So, and granted, it doesn't have to be on the nose 24 months. It could go to 30, 36 months. It could be longer than what we think. But at least it shows me like right now, this isn't the case as far as like the average recession, like post inversion. But 24 months is 24 months, and that's the average. And I could just see this market, surviving and shrugging off a lot of stuff until Q4. And then I'd be, like I said, if we see a bad Q4 this year, that gives me a lot of additional caution going into 2025. But if we see a solid Q4, it's kind of hanging on to everything until 2025 gets nasty.
Well, you're talking about an environment, Chris, if for that to, let's think about what gets us out of the inversion kind of story, right? Because for those of you guys who are just tuning in, if you missed our conversation about this yesterday, we talked about how historically speaking, a inverted yield curve, which is basically long duration being less attractive than short duration bonds, right? Yields being, inverted. When that happens, historically speaking, it has always led to, when it comes out of inversion, it has led to a recession every single time that it's done that in US history. The point with saying that is that, Chris is pointing out that we've stayed in this inversion for like the longest we've ever stayed.
500 plus days. Yep, longest.
So what does that tell you? So what is that? And the thing is, how does it come out of inversion? Well, this reverses. So this number, the yield offered by the 10-year goes down, right? And the
10-year goes up.
Sorry, yeah, it goes up.
Yep.
And this one goes down.
Yep.
And what causes that? Well, it causes the trust in the longer term duration to be diminished, right? I mean, this is the kind of a confusing topic, but the long story short is TLT is an interesting one to watch on this, because if you see TLT start to really jump, would that be the catalyst? I mean, is that the same kind of timing that would cause that to uninvert, or would it go the other way?
Well, I think TLT going up is more of that's just a straight up safe haven play, in my opinion. I think what makes this this is the concern. If we go to the US 10-year and we notice what this period did for the markets, when we rallied up to the top and we hit that 5% peak on the 10-year back in October 2023, that was actually the summer, August, September decline that we saw in 2023 before we started ripping higher. And that was almost to the day, right? We peaked at this 10-year and we saw the bottom in the market that we've been a long ways away from. That bottom in October 2023 is 28, 35, 40% ago. It's a crazy run we've seen for that last, well, I take it back. It's not that bad. What is that run? So from October 2023, we're talking, I mean, it's not that far off, dude. That's a huge run, man. From here to current price, it is a 31% run. So yeah, it's a 30+% run, but you go back to that 10-year yield, and the 10-year yield has done virtually nothing off of this. It's like we had a relief rally in equities. We had a relief rally in the bond market, right? That's what prevented the bonds from going into a 3-year drawdown. But this has not nearly looked the same as the stock market. So that typical inverse correlation of if stocks are up, bonds are down, that's true right now. But I do wonder if we start to see, in order for the yield curve to become normalized or uninverted, the question is the 10-year going to steepen? If the 10-year steepens and gets stronger, let's say that the 10-year revisits this 5% zone again, I don't know if we get beyond that. Like maybe I mean, because the 3-month is at, can you check the 3-month right now, Nick? Is it like 5.3? I can check it too. I think it's like 5.3.
5.25.
Okay, so 5.25 versus 4.41. So let's say that the 3-month doesn't do anything. Let's say the 3-month stays where it is. Well, does that mean that the 10-year is actually going to go to 5.25 or 5.3? Maybe. And if that's the case, we get out of this uninverted. But this did not bode well for stocks here. I would imagine it wouldn't bode well for stocks there either. So again, I just wanted to kind of follow up in this conversation, because yesterday we showed like this is 2000, this is 2007 and 8, this is 2020, this is now. We don't know what this looks like, but I think what makes me nervous is longest inverted yield curve in history, to me, tells me like the cycles and the acceleration that we see, something ugly could happen very quickly. And also, let's piggyback this on what's happening Wednesday with the Fed. The Fed has been very lucky over the last couple of years, even like the last 4 or 5 years, navigating through COVID, post-COVID, navigating inflation. really having to do nothing other than raise rates and then sit and wait and not have to react. The Fed has been very lucky. And in your career and in my career, I rarely see that the consensus is the Fed got it right?
Yep.
Usually it's the Fed is reactive to something and the Fed is breaking something, or something is breaking for the Fed to then step in and put in a backstop.
Yep.
So that's this is big picture stuff, but it's like, that's what makes me nervous about any type of chaos, is that the Fed hasn't broken anything, or the market hasn't seen anything breaking, and therefore nothing has to happen. And I just feel like the longer that goes on, the more violent a break ultimately becomes, whatever that is. And if it's the stock market, if it's the bond market, if it's commodities, if it's the dollar, if it's crypto, I don't know. But if something breaks, I think it's going to be ugly and crazy, and it could be, more violent than we've ever seen in the past, because this is what happens when something just sits and boils and bubbles under the surface until it finally erupts.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button, or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.